Welcome back to the Deep Dive. Today, we're cutting straight through the noise. We've got our hands on the pre-market strategy notes from a top-tier institutional fund. The date is Thursday, December 11th, 2025. You've probably seen the headlines, celebrating multi-week highs, but this is about the infrastructure underneath that rally.
That's exactly right. The official sentiment is, let's say, running neutral to maybe slightly bullish, and that's all fueled by the recent Fed action. But as we dig into the plumbing, you find this. Structural fragility. If you're only looking at the surface rally, you are going to get blindsided. We're talking about three things: fragile liquidity, hidden volatility risks, and a complete breakdown in traditional diversification.
So our mission today is to move beyond those headlines and make sure you understand the complex, subtle cross-currents driving institutional positioning right now. What are the high-conviction trades? And maybe more importantly, where are the traps? Let's find out. Okay, so let's unpack this. There's been a really clear shift in market tone this week. What was the single biggest catalyst? The thing that powered the S&P 500 to a 6-week high, even with all these inflation concerns floating around.
That reset came directly from the Federal Reserve, no question. They executed it was highly anticipated, but it was still very powerful dovish pivot. They dropped rates by 25 basis points. That brings the total easing since last September to a pretty significant 175 basis points. And crucially, they announced plans to purchase $40 billion of Treasury bills per month.
Right, the T-bill buying. That's what everyone's calling QE-lite.
So how is this different from the, full-blown quantitative easing we saw before, the kind that was designed to crush long-term rates? That's a really important distinction for you to grasp. Traditional QE, that was all about buying long-term bonds. The goal was to suppress the 10-year yield, push people into riskier assets. This QE-lite is different. It's purely focused on short-term T-bills. So it's less about stimulating the whole economy and more about managing the plumbing, just ensuring there are enough bank reserves in the system to alleviate any short-term funding stress. It's an administrative liquidity boost, not a huge monetary stimulus package.
Okay, so the market cheers the liquidity, but here's the confusing part, right? The inflation data. The Fed is cutting rates, but what did the latest November CPI data tell us?
The data was stubborn. Headline CPI came in a little bit warmer than consensus, plus 3.3% year over year. And Core CPI, which is what the Fed really watches, it decelerated only modestly. It's still persistent at plus 3.8%. So yes, inflation is trending down, but it's slow. And it's still way above the Fed's comfort zone.
And this creates that key divergence, what the big funds are calling the hawkish cut expectation. The Fed is dovish, but the fixed income market, it's reacting hawkishly. We saw the 10-year Treasury yield pushed above 4.21%, a 3-month high. If the Fed is cutting, shouldn't yields be crashing?
They should, yeah. If the bond market really believed this was a clear path to a soft landing, then bond prices would be skyrocketing and yields would fall. The fact that long-term yields are actually rising, it suggests the market is pricing in some structural concerns. They're demanding higher compensation for holding long-duration assets because they believe one of two things: either that robust economic growth is coming, which will just reignite inflation later, or that inflation, especially core, is just going to be stickier than the Fed hopes, forcing higher rates for longer.
So equities are partying because of the cash injection, but the bond market is basically screaming that the party is built on sand. That contradiction really sets the tone for everything else. And that takes us right into the pre-market flows. We see the big indices, ES and NQ, kind of consolidating after that big move up. They're trading in these tight, well-defended ranges. But let's look away from the mega caps for a second. What's the RTY, the Russell 2000, telling us about the health of this whole thing?
The RTY is, it's the canary in the coal mine right now, and it is singing loudly. It has shown significant relative strength, outperforming its large cap counterparts. It rallied, 1.32% to record highs on Wednesday?
And why is the Russell breaking out so important right now?
Because for the last couple of years, this rally has been incredibly narrow. It was all driven by the Magnificent Seven, big tech, a very small slice of U.S. large caps.
Yeah.
When you see the RTY, which is mostly smaller domestic companies, when you see that breaking out, it signifies a potential broadening of the rally. Capital is moving beyond the obvious names, and that's historically a very healthy sign.
But, like you warned at the top, we shouldn't confuse a broadening rally with robust liquidity. Our sources are stressing that liquidity is fragile, even with tight bid-ask spreads. What's creating that fragility?
The problem isn't trading small volumes. The issue is the depth of the order book at the extremes. Market depth, so the number of orders waiting to execute, it just thins out dramatically away from the current price. In practical terms, a medium-sized fund trying to sell aggressively near an overnight low, they're going to chew through the existing buy orders very, very quickly.
Which leads to those infamous liquidity grabs. For anyone listening, what exactly is happening there? How does a thin order book cause that?
Think of it like a crowded doorway. A small rush gets through fine, but a slightly larger crowd creates a bottleneck. A liquidity grab is when a powerful short-term trade pushes the price just low enough to trigger all the automated stop-loss orders, the stops. Because the order book is thin right there, prices flash down, stops get hit, and then the institutions who set the trap just reverse and buy it all back cheaper. It leaves the short-term traders trapped. The fact that minor probes below the overnight lows for ES and NQ were bought back so quickly, that confirms active money is defending those thin zones.
Okay, so systemically, we mentioned the Fed's QE-lite. You noted those purchases are justified because a huge systemic safety valve has dwindled to almost zero. You're talking about the Overnight Reverse Repo facility, the ON-RRP. Why is that drying up so scary for the system? Can you give us a quick metaphor for what it does?
Sure. Think of the on and RRP balance as the massive emergency gas tank on the financial system's car. For years, huge amounts of money, over $2 trillion at its peak, were just parked there by money market funds. They were essentially lending cash overnight to the Fed. It provided a massive buffer against funding stress. Now, that emergency tank is basically empty. The cash is back circulating, which is good for liquidity, but the safety valve itself is gone. The Fed's T-bill purchases, that's the government frantically trying to refill the tank with a smaller hose. It just underscores how fragile the underlying structure is.
And that fragility is just not reflected in the headline VIX number at all. It's trading in a calm, 15.5 to 17 range? That just screams market complacency, risk on, right?
It absolutely does. It reinforces that surface calm. We also see the VIX term structure in its normal state, which is contango. That just means longer-dated futures are priced higher than the near-term ones. No immediate panic.
But the VIX level itself can be so deceptive. What are the hidden risks that the headline number misses? Let's start with the slope of that term structure. It's flattening out into the front months.
Yeah, that flattening slope is the first red flag. If the market were truly comfortable, that slope would be steep. You'd price VIX futures much lower in the near term because you expect clear skies. A flat slope means they see volatility persisting. It suggests sustained, unresolved uncertainty over the next few months, not a clear path to zero risk.
And the hedging backs that up. We're seeing big players buying long-dated VIX calls way out into 2026. That's insurance. Why are they paying a premium for insurance if the market is so calm?
Because they know the calm is artificial. And the second major tell is the equity index options skew. It's still consistently negative. So if you're listening, how should you think about negative skew practically?
Think of it this way. Skew measures the relative demand between put options, which is your downside protection, and call options, your upside bets. Negative skew just means investors are paying a huge premium for puts compared to calls. It's like paying twice the normal rate for earthquake insurance, even when the sun is shining. It means they're always hedging against the tail risk.
Exactly. The market is complacent on broad volatility. That's your low spot VIX. But institutionally, they are acutely aware of specific sudden risks. That's your flat contango and your negative skew. So a sudden catalyst, and a geopolitical shock, an unexpected credit event, it could ignite fireworks. And that flat VIX curve means there's less structural protection against short-term spikes.
And now we get to the core problem. The thing challenging every traditional portfolio. I mean, when I first learned finance, the 60-40 portfolio was basically gospel. How revolutionary is it that this foundational concept is now functionally useless in a crisis?
It is revolutionary, and it is the most important structural shift since the GFC, hands down. The foundation of the 60-40, that when your 60% stocks go down, your 40% bonds go up, that relied on a negative correlation between equities and fixed income. That negative correlation is dead.
Dead since 2022, and it persists today. So what's the correlation now? What does that mean when stress hits?
The correlation has flipped to sustained positive correlation. So when risk is off, both equities and bonds sell off at the same time. When a major risk event hits, your fixed income hedge gives you zero benefit. It's essentially exposing the entire portfolio to unhedged risk, forcing investors to look for completely new hedging mechanisms.
And it's not just stocks and bonds. We're seeing a major split in the traditional crisis hedges too.
Yeah.
Specifically, gold and Bitcoin. Gold is near record highs, around $4,200 an ounce.
Gold is doing exactly what it's supposed to do. It's confirming its role as the definitive inflation and crisis hedge. Its strength is supported by central bank demand and a weaker dollar. It's fulfilling its mandate.
But Bitcoin, which many hoped would be digital gold, broke that correlation early in 2025. It's not moving with gold as a crisis hedge. So what is Bitcoin acting like now?
Bitcoin has firmly transitioned into a higher beta risk asset. Its price action is highly sensitive to liquidity and speculation. It tracks much closer to, say, tech stocks or small cap growth than it does to gold. The key takeaway for you is that you cannot rely on Bitcoin as a substitute for gold in a crisis hedging strategy. It's just not.
It really is a bizarre cocktail, isn't it? The S&P is roaring, the dollar's weak near 99.1, and yet those 10-year yields just refuse to drop below 4.20%. This whole mix, it points to a global risk-on rotation, but one where the bond market refuses to let go of its inflation fears. So we have fragile liquidity, deceptive volatility, broken correlations. What does all this complexity boil down to? What's a high-conviction institutional trading thesis in this environment?
The bias is still constructive. They're not outright bearish, but it requires extreme discipline. The core strategy is really built on two pillars: relative strength plays and discipline protection.
Okay, let's detail that. What does a relative strength long look like right now?
It means focusing on the areas showing confirmed strength beyond the usual suspects. So, longs in Alt-Y, high-quality growth stocks companies with resilient balance sheets, strong free cash flow, often in AI infrastructure, places like that. They're going where the money is flowing today, which is into that broadening rally.
And balancing that with a defensive posture, the discipline protection.
Absolutely. Because of the fragility we just talked about, the depleted RRP, the flat VIX curve, they are maintaining explicit, asymmetric, long-volatility hedges. That means buying long-dated, out-of-the-money options or VIX calls. It's a way to guard against those non-linear volatility spikes that the current low VIX level is hiding. You're paying a small fee now for huge protection if the calm breaks.
All right, let's talk about where the market consensus might be making a huge mistake. What are they pricing in too aggressively?
They're pricing in too much certainty. Certainty about the timing and the magnitude of future Fed rate cuts starting in mid-2026. The current optimism suggests this perfect linear path to disinflation and a soft landing. The market is assuming the Fed will start cutting the second inflation hits 2%.
But if core CPI proves stickier, say it stays above 3%, well into 2026, that whole soft landing narrative just collapses. The Fed would be forced to stay restrictive for longer than anyone anticipates.
That's the structural vulnerability. And that exact scenario sets up the ultimate pain trade, the event that would catch almost everyone off guard.
Define the pain trade for us in this context.
The pain trade would be a hard landing combined with a reacceleration in inflation. Imagine a major credit event or a geopolitical shock that just tanks growth, but supply chain pressures keep inflation high. Central banks would be paralyzed. They can't cut rates to support the hard landing without just fueling the inflation fire. In that scenario, both growth assets like equities and inflation hedges like bonds struggle at the same time. It would be catastrophic.
So to avoid that pain, we need tripwires. What's the one critical, practical pivot level that institutions are watching to trigger a full defensive reversal?
The signal they're monitoring is funding stress, a direct measure of market liquidity. The critical pivot level is the secured overnight financing rate, or SOFR, consistently trading above 4.25%. That rate is what it costs banks to borrow cash overnight, since the Fed is trying to stabilize funding with QE-lite. SOFR spiking above 4.25% signals that the Fed's efforts are failing, the system is genuinely stressed, and a full de-risking event is probably imminent.
We've really drilled down deep today. For you listening, the summary is this. The Fed injected cash, but the system is running on fumes. That on-RRP is empty. The rally is broadening. That's your RTY strength, which is healthy, but it's fragile. Volatility is deceptive. And most critically, that traditional 60-40 diversification model is broken. So active management and discipline protection are mandatory now.
And if you need one final provocative thought to monitor all this complexity, just remember the ultimate red flag we talked about, the VIX term structure. We're in contango now, that's calm. The signal that necessitates an immediate full reversal to a deeply defensive stance, the true sign of panic, is a rapid and sustained inversion of that VIX term structure. That's called backwardation, specifically where the front-month VIX rises above 30 and stays elevated for more than a week. That signals genuine broad-based panic, a complete regime shift.
Keep that 30 VIX backwardation level firmly in view. Thank you for joining us for this deep dive into the mechanics of institutional risk. We'll talk soon.